Thank you very much, Joanne. Joanne and I were just kids when we started out together, right? So it's a pleasure to be here, and it's my pleasure to introduce Dick Coey. BNY Mellon, as you may or may not know, is an investments company. You may think of us as a bank, but over the years we've really ended up focusing in two businesses, investment services and investment management, where we actually own 16 different investment boutiques, accounting for about $1.6 trillion in assets. So for us to have a chief economist, you can imagine that the chief economist of the firm would have to be a rather accomplished person in the investments business, and I think that's what makes our speaker today, Dick Coey, so special. Dick is a very well-educated man, went to Yale, studied politics and economics, got his MBA at New York University Stern in investments. Started out his career as an investment professional. So he co-owned an investment firm where he was also a portfolio manager. And so he has his roots in his perspective as a chief economist come out of the investment experience he had. And I think what makes Dick such a popular speaker for all of our clients who want to hear from him on a regular basis is that he's very practical in the way he looks at the world and the geopolitical events and the economic events, and sort of comes up with perspective that investors value in terms of how they can navigate through all of this. So Dick, we're very happy to have you here, and thank you. He's been the chief economist for a long time at various firms on Wall Street, and with us beginning with Dreyfus in the early 90s, and is now the chief economist for BNY Mellon in total. So with that, Dick.
Let me test and see whether you can hear me clearly. Can you hear me clearly this way? Okay, if you can't hear me clearly, please raise your hand. We're okay. No problem. It's a little better communication, I think, because it's a little echoey with the microphone. So if you can't hear me, just raise your hand and I'll raise the level of my voice. I'm a particular kind of economist. I'm a very market-oriented economist. I made a presentation yesterday on frontier markets on a panel with a Nobel Prize-winning economist who's a professor at NYU. I share with him an NYU background. I completed my coursework orals back in the late 1960s for my PhD, and I'm only 45 years late for my dissertation. I'm not an academic, econometric economist. I'm a man of the markets. I managed money equity portfolios twice in my career, once in the 1970s and once in the 1990s. Relevant to this group, in the 1990s when I was managing my fund, I probably bought 100 to 120 IPOs as a portfolio manager. And having them come in, it's a little later stage than you deal with, but it's kind of where the ultimate goal in some cases is either the IPO or sell out to somebody else. So I'm kind of interested in that point. Let me briefly set the economic outlook, then give you kind of a financial markets outlook, a currency outlook. And then I'd like to throw it open to questions, because I think with this size group, you don't really need a long monologue. Let's just kind of open it up. So if you think about how do we get where we got right now, the long story is that we had something called the Great Doubling of the labor force with the fall of the Berlin Wall and China joining the WTO. The labor force that was relevant to the modern economy doubled. If you go back 30 years ago, the Chinese labor force meant nothing to the modern economy. The Indian labor force meant nothing to the modern economy. But over the last, 20 years, this doubling of the labor force had some very powerful effects, both positive and negative. Broadly, it was very positive because it was the biggest rise in global standard of living in the history of the world. because we took people in poverty and gave them modern skills. So in China, a man might have been at 8 years old behind the plow in the field. And at age 32, he could be managing the clean room of a semiconductor factory. Technology that was not developed in China, but was forwarded from Europe or from the United States. 400 years of intellectual capital was made available for free to this tremendous labor force. And so it worked tremendously on a global basis to raise the world's standard of living, but there were some losers, and including the major loser was anybody selling low-skill or mid-skill labor in Japan, the United States, or Europe, because you were competing with cheaper labor, and as a result, we've had a stagnation in median income, not in the total income of which includes the wealthier and more successful, but at the median level, the developed world has had a stagnation in median income. For a while, people in Europe, United States tried to maintain their spending by borrowing money. And we had a housing bubble which permitted home equity loans to be financed, and people weren't necessarily living off the rise in their incomes, they were living off the rise in their debt. And that worked for a while, until around 2008, when we had the worst financial crisis since the Great Depression. And we were talking about it earlier, people were mighty scared, and what I noticed during that period of time is the higher the rank of the person in the financial world, the more absolutely petrified they were. You know, the middle people were a little scared, the people at the top were absolutely scared. And in fact, we were that close to a total financial meltdown. I wouldn't say it to the press, but for about 48 hours, Bank of New York Mellon was the central bank of the world. The central banks get a daily statement of exposure, but they don't know what's going on intraday. A lot of the financial institutions, what they had to know is they were okay with their credit officer at BNY Mellon at 11 in the morning on the day of the crisis. Now, we don't like to mention this too much because it could create the logic that there's such a thing as a too-big-to-fail bank. Now, my view on that is, well, let's put it this way. The artist formerly known as Prince is still Prince. So I'll let you think through the logic of the situation. So we had this financial crisis. We had an aggressive response to try to bring it out. And we've had a weak economic recovery ever since. My view is we've completed 5 years of an economic expansion at an average GDP growth rate of about 2.2%. And we've just made the transition to an average growth rate of about 3% for 3 years. We have a long economic expansion because slow growth gives you a long expansion. You don't easily get to the extremes of inflationary pressures on the upside, the extremes of credit exposure on the upside that brings you an early recession. So one of my themes over the past several years is that we had a long expansion in front of us. And that explains why the stock market has done so well over the last 5 years, but notably over the last 18 months. In the last 18 months, there was not a big upward revision of the forecast for what corporate profits in America would be. So you say to yourself, why did the stock market go up? If everybody forecasts this kind of a pattern of profits and we roughly got it, why would you think that the stock market would go up? And the answer is that the market moved to accept the idea that we had a multi-year expansion in front of us. It was able to discount a rising trend of profits for more years out in the future. And so that rise in the stock market was a shift from a view, gee, it's pretty vulnerable, maybe we'll go into a new recession, maybe it'll break down to the view that, gee, this thing is sustainable. I can think about profits, not just this year, but next year, the year after, and the year after that. Why would we see a upward shift in the growth rate of the U.S. economy? Well, there's a lot of complicated arguments, but let me give you the simple one. Private sector GDP grew 3.1% in the first 5 years of economic recovery, and real GDP grew at 2.2%. What was that 90 basis point difference? That 90 basis point difference was the effect of the federal government and the state and local governments. And the federal government was a drag through fiscal tightening. This was not a brilliant strategy by anybody. This was just the accident of timing. The accident of timing was that the Tea Party won big in the 2010 elections, so they were successful in getting a 10-year sequester, restraining spending. If you're interested in this, I recommend the book by the fellow who was Watergate, not Bernstein, Woodward's book called The Power of Politics, which is great about the politics of it. So first, you restrain your federal spending, and then you had the tax cut in the end of 2012, and you had an economic recovery. So what's occurred in the federal side is we had a fiscal tightening drag for 5 years. It's over. We no longer have substantial tax increases coming. We no longer have incremental cutbacks in spending. And so we have lost a drag. And every time I tell people I think we're going to be about a whole percentage point faster in economic growth, they say, well, what's the new source of strength? To which the answer is, there is none. But there is a source of acceleration from losing a drag. And in the state and local sector always lags about 18 months. So it lags on the upside and it lags on the downside, because it takes a while for the guys in the state governments to figure out the money has stopped coming in or it's started to come in. We have gone from layoffs in the state and local government, which we had for several years. They're now beginning to have net hiring. So we've had a swing both in the federal side and in the state and local side, and so you have an upward shift about 1 percentage point in the U.S. Economy. We now have the shock of a big drop in oil prices, and this has created fears of deflation. But you have to make a differentiation between good deflation, bad deflation, and so-so deflation. What we have is good deflation. Let me start with bad deflation. What bad deflation is prices are very weak because the economy's going down. You have too much excess capacity and you don't have growth in the economy, and down you go. That's kind of what they got in Europe right now. Very weak recovery, the heartbeat's barely alive in Europe. They have a badly designed euro. They're always fighting with each other. When you think about the economic leadership of Europe, the financial leadership of Europe, you're flying through a storm in a big airplane. Suddenly the door to the pilot's to the cockpit flies open, and you see that the pilot is smashing his hand at the co-pilot, and you're worried about whether you're going to be alive. That's the state of decision-making in Europe today. You know, the Germans and the Italians and the French, they just don't agree, and nobody's in charge. You may like what President Obama does, or you may not like it, but we have a system where somebody's actually in charge, unlike the European system. So bad deflation comes from the demand, that you're in recession or very weak growth. It's a symptom of insufficient demand or weak growth. So-so deflation is when you just have a cycle, which we've seen now in, for example, metals. The Australian capital spending on metal mining rose 25-fold. So guess what? Now that China has slowed down a little bit, they've already spent this massive amount in Australia on building new mines. They got all this mine capacity. and down goes the price. This is, I refer to this commodity cycle as a return to the old normal. This is what's been happening in commodities for the last 1,000 years. The overbuilding, low prices mean you cut back your new supply. High prices mean you build a zillion of it. This is normal. What's good deflation? Good deflation is like what comes out of Silicon Valley. Okay? You go back X number of years ago, a cell phone weighed 2 pounds, right? And it was really expensive, a couple $1,000s to buy a cell phone that weighed a couple pounds. That's no longer the current dynamic because there's been technological innovation. And that's good deflation. The fact that the price of that functioning is now cheaper is good deflation. That's what happened in the private sector in the oil and gas business in the United States. It wasn't developed in Silicon Valley. It was developed in the oil patch. But the oil patch people had a technological innovation that made them able to get the oil and the natural gas out of places where they knew it existed. They just didn't know how to get it out profitably. And so they cut the cost of getting it out. It's not like this is a new exploration success. Oh, we suddenly discovered there's oil down there. They always knew there was oil and gas down there. They just didn't know how to get it out. And we had a successful technological innovation. The result of this is that we have had a sharp drop in oil prices because the Saudis said to themselves, well, first of all, we're not going to be the only ones to cut production. So if Venezuela and all the rest of OPEC's not going to play ball, we're not going to be the people to cut production alone. Since they couldn't get them to go along, they couldn't get Russia to go along, they said, okay, we're just going to keep our market share the way it was. Second of all, Saudis have a political objective. There, as you know, there's the great Sunni-Shiite battle that occurred, let's see, I guess it started about 675 AD. It was going on 1,100 years before the founding of the United States. So it's not exactly us creating this. But the Saudis and the Iranians have a little bit of tension, and so it's to Saudis' power advantage for right now to weaken the Iranians by having a low oil price. And thirdly, they say there's big pickup of U.S. oil production. U.S. crude oil production has gone in 4 years from 5 million barrels a day to 9 million barrels a day. That is a breathtaking increase in supply. And so they can't stop it, but they'd like to slow it down somewhat. This means that the global economy is going to do better, but the oil exporters have a problem. I got called yesterday at the last minute to make a speech to a frontier market conference, and I was reading up a little bit on the problems of some of the frontier countries, notably Nigeria. Nigeria sells light crude oil, which is exactly what America has got more and more of. All of a sudden, 6 weeks ago, their central bank sends out a note to the banks, please cut your foreign exchange exposure, implicitly saying, gee, our currency might go down and you might lose money on it. Unfortunately, they didn't send it to them until 6 weeks ago, and that crash in oil prices came pretty fast. I think they had good reason when they said it. So I think there's a lot of countries out there that are oil exporters that are really going to face some challenges. But there are more countries that are oil importers. This is good for U.S., good for China, good for India, good for Europe, good for lots of different parts of the world, and that we have this supply shock making the price of oil lower than it was. Now, let me talk for a second about monetary policy and the currencies. So in terms of the U.S. economy, we're in a sustained economic expansion, 3% growth for the next 3 years and maybe beyond that. The Fed has what's called a dual mandate, full employment and price stability. So think of the unemployment rate and the inflation rate. they have what they're seeing is there's people who are unemployed, there's excess labor, but that's getting reduced every single month. So they're on a time path to having enough improvement in the labor market to feel comfortable raising the interest rate. The other thing is that the Federal Reserve, like other central banks, has an inflation target. Now, the Tea Party types in Congress will call the chairman of the Fed up and say, "You're running a fiat currency." To which the response of the Fed is, "Yeah, of course, we know that. And we've decided, as has the ECB, as has the Bank of Japan, as has the Bank of England, that probably the most practical way to manage a fiat currency, which is intrinsically worthless, is to target inflation so that the real purchasing power of that currency is reasonably forecastable." So almost all of central banks have a target of about a 2% increase in inflation. And they have come to the conclusion this is the best way to manage a fiat currency. In the United States, we are still below target. The inflation rate is still below target. And so that means the Fed is not under that much pressure to raise interest rates very quickly. But since we're normalizing the labor market, I think the Fed is likely to start to raise the Fed funds rate probably June 17th of 2015, when they have an FOMC meeting. Now, the FOMC meets about every 6 weeks, but for some weird reason, they only have a press conference every other meeting. So if you're going to make a giant change, like we've had a zero Fed funds rate since December of 2008, and we'd like to announce this morning we're going up 25 basis points, you probably wouldn't do it at one of the meetings you don't have a press conference. Now, of course, you could always just extend an announcement, we've changed, we're going to do it every time. But in any case, most people think it'll probably be about June 17th, about 2 o'clock in the afternoon. It could be September if the economy is not quite as strong as I anticipate, but they're going to tiptoe up in interest rates. They're not going to spike it hard because they have relatively weak inflation, not a big inflation risk that things take off on the upside. They're not going to raise rates very, very aggressively. Now, of the G4 central banks, the G4 is the US, the UK, Japan, and the ECB. The G4 central banks can be divided into two sets of two. You have the normalizing central banks, which is the Bank of England and the Fed. As their economies improve, as their unemployment rate comes down, they're going to start to gradually raise interest rates. You also have what I call the ZIRP central banks. ZIRP stands for Zero Interest Rate Policy. The ECB is at a negative interest rate. They're not going to raise their interest rates until maybe 2018. About the same for the Bank of Japan. And the ECB may in fact go to quantitative easing. The Japanese just raised their quantitative easing. So you've got this differentiation between the ZIRP central banks and the normalizing central banks. And what this has started to do, and will continue to do, is generate a dollar bull market in the currency markets. Because we're making investments in the US more attractive. The dollar, the interest rates will be going up for the good reason. Sometimes interest rates go up because your inflation is soaring and you have to fight it. That's not a good reason for inflation to go up. But sometimes, for interest rates to go up. But sometimes interest rates go up because your economy's gotten better and you're growing more strongly. That's a perfectly good reason for interest rates to go up. It's just a symptom of the fact that things are better. So what with the ECB thinking about quantitative easing, Japan having increased the size of its quantitative easing, both of them stuck on near zero interest rates for the next several years, this shift to normalization is generating a dollar bull market. And I think it's going to last 2 or 3 years, probably about 3 years, maybe 5 years. And it's going to be pretty substantial, and it's going to have a very, very powerful effect on many economies. Some of the emerging economies, which have weak currencies and sell commodities, they're going to have a real challenging period. So for the United States, the outlook is better economic growth, lower unemployment rate, moderate inflation pressed down by weak oil prices, and a Federal Reserve that very, very gently raises interest rates to levels that is not a big burden on absolutely anybody. But this dollar bull market is a very, very powerful force, and it's going to influence an awful lot of dynamics within the financial sector. So what I'd like to do is stop right now. That's kind of giving you kind of my basic outlook, and I'd like to ask for questions, either about what I've discussed or anything else. Yeah.
Okay, I have a question. Given your outlook, which is very positive, my question is, what do you think about the appetite for risk assets? I mean, if I could make an enormous amount of money on low-risk assets, I mean, is there any reason as an investor for me to start going down the quality slide to try and get that additional IRR? I mean, I sort of figure that the high yield market, the spreads are going to start widening for all sorts of reasons. That's not going to be very interesting. And emerging markets, as you say. So, and the reason I ask that is that we're in the business of risk assets here.
Right.
You could argue. And so I'm just curious as to what your opinion on that is.
Sure. Let me start out narrowly and then address the broader issue. Let me start out narrowly on the high yield bond market. I used to be chief economist at Drexel Burnham, and I was very, very carefully trained never to say junk bonds. They are high yield bonds. They are not junk bonds.
Opportunity bonds.
Opportunity bonds. Right.
That's what we call them at First Boston.
Yeah, absolutely. High yield, the characteristic of the high yield market, if you look back over the last 25, 30 years, is they tend to give you a decent return most for about a decade or so, and then they totally collapse. We had 2 giant collapses in the high yield market with severe losses. One of them was in the run-up to the Drexel bankruptcy, which occurred on February 11th, 1990. But who remembers other than the shareholder employees of the firm? And of course, the second one was with the global financial crisis. So if you think about investing in high yield, it's kind of an okay investment area, except when you're on the foothills of the total devastation. And so my view would be, we've already passed through the period of rising junk bond prices as risk fears dropped. That's over. And so it's kind of a dull area for a while here, because you're not going into the full tilt crisis that'll cause severe losses for a while. On my guess, probably 2018. I would say the junk bond market probably blows up about 2018, maybe 2019, and does another one of these things, but not right away. Now, within the junk market, the high yield market, within the high yield market, about 17% is energy. And there's been a huge amount of high yield paper issued for energy. Keep in mind that we've already had a downward adjustment in the energy bonds. So if you're thinking about losses, if they're already trading at 60 cents on the dollar, and the recovery, even in bankruptcy, is 35, in the size of the overall financial system, This would be painful in a narrow sense, but it's not going to trigger some big, broad element. Keep in mind, the risky parts of energy have financed themselves from final investors and not by bank intermediaries. When banks make loans, if they have a 10% equity, then they have 10 times leverage. So if they lose money, it's leveraged 10 to 1, and that can create a financial crisis. When it's sold to final investors, out there, pension funds, individuals, you don't have that same degree of leverage in the ownership, so when the losses come in, they diffuse throughout the entire system. So, do I own any high-yield bonds or bond funds? No, because the bull market phase of rising prices is over, and now you're just picking up nickels in front of a truck. You're picking up nickels as the truck is coming towards you in the hope that you'll get your hand out before the truck comes by. I'm not a fan of it, but I also would not be shorted because it's going to blow up soon. It shouldn't. What happens, what kills the high yield market, and what kills many other risk assets, is when corporate cash flows and profits collapse. So corporate profits in the energy sector will collapse. Continental Petroleum just a day or two ago cut back their capital spending by 20%. And basically said, we'd like to retain our dividend, our profits are going to be weaker, so we're just going to cut our capital spending. Some of these smaller energy companies, maybe they'll go bankrupt, maybe they'll have to refinance, maybe they'll have to sell stock cheaply because the corporate profits have collapsed. What about corporate profits outside of energy? They're probably going to continue to grow at a moderate rate. No great thesis for why non-energy profits in the U.S. economy should collapse. And as a matter of fact, the weak economies like Europe and Japan probably get a recovery in profits because they haven't had much of a recovery in their economy yet. In terms of risk assets, keep in mind the rate of return on riskless assets is dreadful. Okay? You can buy 10-year treasuries today at 2.16%. You got a pretty good chance if you hold it for a couple of years, the price of the bond will go down. Okay? For 30 years, we had a coupon plus world in the bond market. Because what happened was you started out at high yields. I put out a forecast in Forbes recommending called the last chance this century. Last chance this century to buy bonds in 1981. 10-year treasuries were 16%. 30-year treasuries were 15-20. From 16%, 10-year treasuries came down into 1.37% on July 28, 2012, when everybody's petrified about the euro. So what you had during that entire period is you got your yield, plus you got your capital gain because the bond price